Well, I don't know about deep expertise in the investment sector. 25 years is a long time in financial services, and it's not necessarily that long as well. I think what I've had the benefit of is really to go through a variety of different roles. So I've been on the buy side, I've been on the sell side, I've seen it centrally from the exchange's point of view, and with that, the experience in terms of being able to interact with all manner of investors from Joe Public all the way to the institutional investors and hedge funds has made it really quite exciting because you see the perspectives from so many different angles. Well, I think the investment landscape is quite similar all around, not necessarily just real estate sector to begin with. Generally, investors are fueled and driven by FOMO, or they are driven by fear. So if you suffer from FOMO, you run the risk of just jumping into the next speculative fad, and that's actually very dangerous. If you suffer from fear, then all you do is you keep your money in the bank, hopefully, and not under your mattress. And all your savings gets eroded by inflation. So there's a whole variety of different types of investment products, from financial products all the way to real estate. Some people take the leap of faith, not necessarily fully understanding what they're getting involved with, and they end up in all sorts of trouble. But the key to being able to invest successfully over time is to be educated, to learn about what you're doing, to be informed, and to have access to information, and preferably products that are accessible, as well as products that are not loaded with huge amount of fees, that you can actually generate the return that you hope for in what you express. The future is always full of possibilities, and there are all manner of interesting things that investors have been looking for. Speculators, I would say, tend to look for the exciting things, and they go through the boom and they go through the bust. That's not necessarily a good thing. But what's happening in the investment landscape really is the democratization of what I call financialized products, right? And from early days in my career, I've always been thinking about, why is it that only the big boys win? That can't be the way the world works. You've got to be able to level the playing field and enable all investors, whether they're big or small, to be able to successfully earn their retirement and have a comfortable retirement at the end of the day. So if you think about this, from the early days in my career, one of the things I experienced through the 90s, where you had the global financial crisis, was when everyone talks about Soros short selling the market, killing the Malaysian ringgit, and making a ton of money in there. Why is it that retail investors can only buy and hold and hope for the best, and some of the institutional investors can take both sides of the market? So in those days, what we did was, in the brokerage house, I introduced a feature and a facility for retail investors to borrow shares so that they could sell short as well. So you're armed both sides of the market. Later on, subsequently, when I was involved in wealth management, it was very interesting to see that there were a lot of opportunities for investors to try different things, but only institutional investors really had the access to options, derivatives, complex stuff like that. But how do you simplify and make them accessible in hopefully a painless way, where investors too can express their view on the market successfully without taking too much risk? So we introduced many of such products. But I think with private banks, and I think with many of these distribution channels, is that you need to pay for the advice, or you need to pay for the services or the products. So the fees can get embedded significantly. So take real estate as an example. You've got a few extreme ends. You could, if you've got a huge amount of capital and are willing to take a lot of risk, buy physical real estate and property, whether it's residential or commercial, and you can take bets around that. In fact, many people who do physical real estate investing try to do that in the form of leveraging up. So they borrow a lot of money from the banks who are willing to lend them for certain collateral, and they try to pyramid that. It all works well when the market's going up, and we all know what happens when the market goes down. So you get caught with a lot of exposure, and that could be very, very risky. You have the other end of it, which is the retailized version of securitized financial products called REITs. Very, very popular in Singapore and in some other markets. REITs arguably are mature real estate products that are packaged in a way that generate consistent yield to the investor. And that's something that at the exchange, Singapore Exchange, is very, very proud to have done 20 years of a REIT market, enabling a lot of investors to be able to access these simplified products for small amounts of capital. But they are very mature products. They are, in some ways, the institutional guys would say, this is where they exit and sell it to the retail public. So where's the juice? The juice perhaps is in the middle. What happens when at the development stage, risks are of course different? What happens when at the project level, risks are very different? It's very difficult for individual retail investors to access these kind of products, access these kind of projects in any sensible form. You could buy a fund that Blackstone has created that gives you that kind of exposure, and the institutions invest through Blackstone. But hang on a minute, the fees that you'll get loaded on that would take away some portion of your return. Or you could try to invest in the project level, and at the project level, it will be too complicated because you have to come up with a huge outlay and you're probably not get financing for it. So RealVantage comes in because the technology has evolved today where you can fractionalize some of these investments. And when you can fractionalize some of these investments, you can actually spread your bets around. You can invest in bite sizes of 25,000 rather than 250,000 a pot. And by doing so, you can have a variety of different choices and create a menu where you can have a higher potential yield or higher potential growth return, as well as you can actually be able to participate together alongside the big boys. The big boys may win, but you can join them. And that's, I think, the beauty of something of a platform like RealVantage, which is enabled through technology as well as the accessibility of the products. Well, the investors are very often driven, as I mentioned earlier, by FOMO, as well as by fear. So at the top of the markets, everyone wants to get involved because there's a fear of missing out. And this happens in all asset classes, whether it's in equities and even cryptocurrencies and so on, right? And you know that when the taxi driver is talking about it, the hairdresser is talking about it, it is normally the top of the market. And that's where investors tend to get into trouble. And then they become non-believers. But the risk and the flip side of that is fear. And the fear of not taking any risk means that in a world where inflation is running in the mid-single digits, your savings are being eroded by inflation. So you can't not do anything about it. So for non-believers, for folks who don't believe that there are real opportunities to actually invest sensibly, don't do it if you don't understand it. But take that interest, take that time and learn about it. Some things are more complex, some things are less complex. I always say, if you don't understand what you're investing in, don't do it. But if you learn about it, you can take the baby steps. And if you take the baby steps and you are successful at it, meaning that you actually educated about it, you understand it, you know that you can make a return, but you're doing it sensibly, spreading your bets in a diversified way rather than putting everything concentrated in one place and taking a lot of leverage and financing on it, then I think it works. And the way I think about investing in general, not necessarily just real estate investing, is start small, spread it out, sleep easy. Well, I think traditional asset classes that many investors have focused on, there are good reasons to be in equities, there are good reasons to be in fixed income. Some of us brave the world of alternatives, including commodities. The more exotic fellas would even try their hands at crypto, which I'm rather cautious about. But in the world that we live in, it's filled with so much uncertainty. We are going through a sea change in 2024. We're going through a sea change that has been going on for the last couple of years, where the entire geopolitical system has come on a complete upheaval, with stuff that's going on in the Middle East, stuff that's going on in Russia and Ukraine, potentially who's going to sit in the White House at the end of the year. Who knows what's going to happen? So investing in a traditional 60-40 equities fixed income spread hasn't really worked so well conventionally versus the last 30 years. The need for alternatives is important. But what kind of alternatives? Do you diversify so much and spread your bets until nothing makes sense? Or do you take sensible choices and do a little bit of a few different things? So, with the world being more uncertain, with the risk of volatility being high in traditional asset classes, and that includes publicly listed REITs, where clearly with the rising interest rate environment of 2022 and 2023, we're seeing capital values of REITs come down. Maybe rates might fall and REITs might recover a little bit, but there is a difference between real estate, real investment and securitized financial investments. And if you think about a platform like RealVantage, it's not something that has just developed overnight. It's been around for a couple of years. There are 24 transactions that have been successfully matured with capital returned to investors for products that projects that have come true that include growth opportunities. The return and the IRR is about 20%. For products that are more yield generating, the return has been about 7%. So over 70 products launched, 24 have actually matured, and you don't have your daily mark-to-market to worry about. Of course, there are risks. There are risks of illiquidity. You've got to stick through the end of the cycle, 1 year, 2 years maybe. But start small, spread it out, sleep easy.